All right, we're going to get started here. So I hope everyone's having a fantastic day. My name is Tyler Braun. I'm the Director of Financial Planning here at the Tranel Finance Group, and I'm really excited to be talking about building wealth today. So this is the first time I've done this webinar. We just put it together. This is a culmination of many client cases, many studies, many years of experience that we've put together. And really this webinar was designed to be over an hour long when I put everything together. But we don't like to make these more than 30 minutes. So we're going to be done right around 11:30 here this morning. And I'm going to talk through a few concepts, three big concepts today, which is step one of the roadmap to building wealth. And this is something that doesn't matter what phase you are in, whether you're in retirement, whether you're just getting started, all of these concepts stack on top of each other and can be utilized at any time. So I'm real excited about this. So we're going to get started. I always start with an agenda. So agenda for today, as we look at it, we're going to talk about accumulation versus distribution. And I always joke around, why not both? We're going to talk about a concept that we talk with many of our clients about, which is double compounding, multiple avenues of income. I refer to those as channels, and cash flow is king. You might have heard cash is king, but cash flow is king. The big one that we're going to focus on is money in motion builds wealth. And then I'm going to talk about utilizing all those options together. So with that being said, let's get started. So accumulation versus distribution. Anytime you research, whether it's finance, whether it's retirement planning, they talk about two different distinct phases in a person's wealth career. And they usually categorize it as the accumulation phase, which is somebody that is not yet utilizing distributions from their portfolio. So they're building net worth. They're focusing heavily on increasing the number of shares that they own. And their mindset is really save, save, save. And I want you to think of yourself. Many of us are in that ballpark all the time, right? We're focused on how do we save more assets. The efficiency behind that is you need to create a plan that is repeatable, that you know works. That's the accumulation phase. Those of you that might be over age 73 and taking an RMD or be in retirement and need to take a distribution from your portfolios, many people in that avenue call themselves in the distribution phase of their financial career, right? And that's typically someone who's taken withdrawals from an account. They're more focused on retaining the assets and making sure that they can live the lifestyle that they deserve and have worked hard for. Might be taking a required minimum distribution, and typically they're equating that to retirement or some form of retirement. So what if you could still accumulate assets regardless of what phase you're in? Why would we not want to do that? And that's the true avenue behind building wealth, is doing everything you should be at a young age, but then not stopping and letting your money continue to work for you. And that's going to be key. So the first concept that we're going to talk through today is called double compounding in dollar cost averaging. So many of you did this throughout your working career, where you were accruing assets inside of a 401k, 403b, 457 plan. Well, the number one avenue to get the highest return on your 401k is making sure that you're putting in enough to get the match. And I know that sounds very remedial when I say that, but think about it. If you're putting in $10,000 a year into your 401k and you're getting a match from your employer of, let's say, $4,000, that's a 40% return on your investment right away. You put 10,000 in, they matched you with 4,000. You just received a 40% upswing for putting in the contribution. You'd be amazed at how many people don't take advantage of that fully. Or I'll talk to someone and they'll say, well, I'm not going to be with this company very long, so I'm not going to take part in the 401k. Or I'm planning on retiring in a year or two. I'm just not going to take part in that. Well, don't leave the money on the table. At least put enough in to get the full match. If you need to put 6% in to get a 6% match, that is a 100% return on your investment. And we call that double compounding. And the reason we say that is you're making a contribution and your company's giving you a match. So you have two avenues that are filling up this 401k and allowing you to accrue shares over time. The advantage that you have by doing this is you are dollar cost averaging. So dollar cost averaging by definition is making periodic payments. So when you were working, you were putting money into your 401k every paycheck. So every 2 weeks, you were putting money into your 401k. So if you're putting in a contribution and you're getting a match, you're buying more shares. What you're doing is you're taking advantage of the volatility of the market. And this is where retirees or people that are no longer able to add to an old 401k plan or an old IRA get frustrated. They get frustrated because they look at their old IRA or they look at their old 401k, and when the market's up, you're really happy, but when the market's down, you're down and you're really upset. And then they'll look at their 401k and they'll say, well, the 401k did better. Not necessarily. You were making contributions to the 401k and getting a match, so you own more shares. And think about this. So if the market is going up and you're putting money in every 2 weeks, let's say that you were able to purchase shares for $10 per share. If 2 weeks later the market falls and you're able to purchase those same shares for $5 a share, most people would say, well, my price is down, right? It is true. You bought some at $10 a share. 2 weeks later, you bought the same stock for $5 a share. But what happened is you just reduced your average share price to $7.50. All you have to do is get back above $7.50, which is your average price, and you're actually making money. So what dollar cost averaging does, the reason it takes advantage of the market's ups and downs is over time, you're reducing your average share price, which means you're actually acquiring more shares. And as the market grows over time, the more shares you own, the bigger gains you see in the account. So I know for a lot of you, this is very beginner level, but I want to focus on it because where I see retirees or people that continue to progress through their financial career struggle is not connecting all the dots to say, is your asset dollar cost averaging without you having to make a contribution? And that's the key phrase that we look at. So in terms of, a portfolio, think of somebody who worked for, let's say, Abbott for 15 years. And they left the company and went to, you name it, went to Johnson & Johnson. So let's say that they rolled over at that time a $500,000 401k. So they have $500,000 sitting in a 401k, and they would be at the mercy of the market going up and the market going down, right? The issue with that is they're no longer able to make contributions. So we need to start looking at avenues on how we can get a double compounding effect inside of that account so the money is making contributions on their behalf. So let's put this into practice and show you a real life example. Let's say that you're an individual who's 58 years old and you're currently employed in adding to your 401k through your employer. Let's say that you have a $700,000 IRA from an old or an ex-employer, but you're no longer able to contribute to that IRA because you're adding to your current 401k, right? The IRS says you can only add so much pre-tax money. You're adding into your 401k through work and can't put into that $700,000 IRA. I see this all the time. And the clients that I talk to get frustrated, just like last year when the market's down 18%, and they're saying, gosh, I don't want to see my account take this big hit, especially because I'm getting closer to retirement. And you know what? I'm probably going to need to take some income when I retire. How can I position this differently to get more out of my investments or get them working harder for me? That's the question that I hear all the time. How do we get these working harder for you? So in this example, let's say that they have a 401k and they're contributing $22,500 to that 401k, and they're getting a $4,000 match from their employer. So the total contribution that they're putting into their 401k is $26,500. So let's think about that. We talked about the double compounding. They're putting a contribution in and they're getting a match from their employer. They're doing everything they should with that bucket, and they're dollar cost averaging, right? They're putting in every 2 weeks as they get paid. The $700,000 they had in an IRA was just in a balanced fund previously that paid little to no dividend. And what that meant is they were putting nothing into the account. So there was no contributions going into the 700,000, and the money was not making any contributions on their behalf. So what we did is we readjusted that allocation of that IRA to start focusing a little bit more heavily on dividends and yield. So you can see a 3.5% dividend on $700,000 allowed them to start reinvesting a total of $24,500 of dividends back into the account that they no longer had to write checks for as a contribution. So they went from contributing $26,500 into their 401k, and that was being used to acquire shares in dollar cost average, right? Every 2 weeks, they're buying shares, which is increasing their net worth because the more shares you own, as the market goes up, the bigger gains you see. And they started to utilize the 700,000 to make a contribution on their behalf through the dividend reinvestment. And those dividends totaled $24,500 a year. They just went from acquiring $26,500 worth of shares to acquiring over $51,000 per year of shares going forward. That's a huge difference. They almost doubled the amount of money that was going in to acquire more shares. And remember, with dividends, the more shares you have, the more dividends you get. The more dividends you get, the more shares you buy. It creates a snowball cycle as you're preparing for that income phase or distribution phase when you get to retirement. So what it allows an individual to do is take an account that you were no longer able to dollar cost average with and start dollar cost averaging. So if you own 10 or 20 different companies, all these companies have different fiscal years, which means every single month you have dividends landing in the account. And now you're dollar cost averaging through the volatility, just like you were when you were working, and it allows you to reduce the volatility inside the portfolio. You're taking advantage of the ups and the downs of the market. I know this is a lot, but we're going to keep going here. That's one concept. We can go through this much more in detail when we start stacking all of these on top of each other. Next piece that we're going to talk about is having multiple streams of income or wealth. So, you've heard diversification. We talk about that all the time. But a lot of people will say, well, I'm going to start saving into this bucket once I complete this bucket. Or I'm just going to focus on here. And I heard about this Roth IRA thing, or I heard about an after-tax account once, and I don't know anything about it. So I'm just going to keep doing what I'm doing. We always want you thinking of future cash flow or accumulation opportunities. And is the asset that you have working as efficiently as it should be for your goal? So for example, most clients, when they come to us, and this is a true story with a client here, I'm just not going to put any names down. The client was a great saver. They had approximately $150,000 in their savings account, and they were getting about 0.01% interest in savings. Now, interest rates have gone up exponentially, even in money markets, CDs, savings accounts. But their local bank that they were at was paying 0.01% interest on their savings accounts. So they had $150,000 in the account. They were making about $15 a year in interest. They were good savers, right? You don't get to $150,000 if you're not a good saver. They were adding approximately $5,000 per year to their Roth, And they said, you know what, I can't max this out. You can go all the way up to, they were over 50 years old. So you can save all the way up to $7,500 per year into your Roth. And they said, I can't do it. 5,000 is all we can save per year. And I respect that. And, I asked them, I said, are you putting anything into your after-tax investments? So just your joint account with her and her spouse. And she said, no, they're not able to fund that. So she was doing everything that she thought she could do. This is the beauty of getting your money in motion and efficiency. And this blows my mind when I start going through this. So what we did is we sat down with the client and I said, we need that 150,000 to get working harder. And we started the process of getting that momentum going. So we utilized a money market, and that money market was still FDIC insured, had zero risk to the client, and it was paying them 5% interest. So think about that. We just took 0.01 and turned it into 5%. And I know you guys are thinking, hey, I didn't log into this webinar to hear how to make more on my money market. I totally get that. But what that did is it freed up $7,500 per year of interest that she wasn't getting. And we took that $7,500 and guess what we did? We funded the next channel or bucket to create more wealth. Remember, she was only putting in $5,000 a year because that's all she could afford to do. Now her money is making the contribution into her Roth IRA for her, and she still has the 150,000 that she started with. That Roth IRA is now maxed out, and she can use that $5,000 that she was contributing previously to the Roth to start adding to her next channel or avenue and checking the next box for her wealth. So as you stack these, what you're doing is maximizing your next efficiency, and creating these building blocks of wealth that when everything's working together, it will absolutely hum. So the goal behind the Roth IRA is you want tax-free growth, and you would like to see a larger amount of gain than what you're getting in the money market. What you're doing with the interest is you're taking the interest that you would have paid taxes on anyway, and you're saying, I'm now taking it out of one bucket where I'll pay taxes in the future and putting it into a tax-free bucket. That's the efficiency. The 5,000 that they were already saving per year, they're just putting that into another after-tax account to continue to accumulate more wealth. So do that for 10 years. What I put here is I said, if you continued to do this model for a 10-year period, and you averaged a 7% gain in the Roth IRA and a 7% gain in the after-tax account, they started with 150,000. They were contributing $5,000 per year previously. But by doing this $7,500 of interest going into the Roth IRA grows to be $118,000 after 10 years. So think about the wealth tool that they just generated. They've now created an after-tax account with almost 79,000 in it. They have a Roth IRA with over 118,000 in it, and they still have the initial 150,000 that they started with. So they took their 150,000 in savings that was earning nothing, changed the way that it was invested from an efficiency standpoint without increasing the risk level, and used the proceeds to fund the next channel, and then took the 5,000 they were saving and funded the next channel. They just continued to get that money in motion because money in motion is what truly builds wealth. Let's take it a step further and look from a perspective of a client who just inherited some assets. So I had a client who I met with, this is probably about 3 or 4 months ago, and they had inherited about $600,000 of after-tax assets. And they had a rental they wanted to acquire a rental property, and they were going to cash in that $600,000, and they were going to buy the rental property outright. Now, with real estate, and we're not doing a real estate, webinar today, but with real estate, you hold real estate for really 3 purposes: cash flow. generates cash flow. It gives you some tax advantages through depreciation and write-offs. And your tenant is also paying down your mortgage for you typically. Their biggest piece that they wanted to look at is they're saying we really don't need the cash flow currently. We want to continue to build our wealth because they want to retire in the next roughly 10-year time period. How do we do that? So what they did is they acquired a property for approximately $300,000, the investment property. Okay, they had some money that they had already saved on the sideline, so they financed that property. And when they did this, they received a $600,000 inheritance, and they were going to cash it in. So they were, it was a stepped up cost basis. So really it was going to be tax neutral. And they're saying, I'm just going to cash this in. I'm going to pay off this rental property. But the stock that they hold or held, continue to hold actually, is paying about a 4% dividend. So 4% of 600,000 means they're getting a dividend of about $2,000 per month, $24,000 per year. When we ran the math on the cost of their mortgage and their taxes combined, it was about $22,800 per year in mortgage and tax expense. The income that would generate, that property would generate, was about $1,500 per month or $18,000 per year going forward. And they wanted to retire, remember, in about 10 years. So what I told them is, let's get the money in motion and let your assets pay for the next asset, which is going to fill up your investment bucket. And I know that sounds really nerdy, and it sounds like it's one thing to the next. But what we did is, remember, this is a dividend. It's a qualified dividend. That means that it's taxed typically at a lower rate. That's taxed whether you take it out or reinvest it. I said, let's take the dividend from the portfolio. Rather than selling the stock, the dividend is going to pay regardless of the share price. Let's continue to hold the stock and you'll thank me later. We're going to take the dividend from the portfolio and we're going to use that to pay for your mortgage and taxes on your rental property every single month. You now freed up $1,500 per month of income. And if you had a tenant that, didn't pay you rent for a month, you don't ever have to worry about missing a mortgage payment or being short on cash flow. Luckily, they've had a good tenant and they haven't had to worry about that. But that generates approximately $18,000 per year annually. That's where most people stop. Most people say, hey, I'm getting great cash flow off this. They don't take the next step to build the wealth. And the next step is taking that income that was generated and now funding your next bucket. In this example, what they did is they funded an after-tax account that was building for them. The reason that we do this, and when we run the math, remember, they acquired the property for $300,000. 10 years from now, they're still going to owe approximately $250,000 because banks always front load the interest on any mortgage. But what they were able to do is take this $18,000 per year, and even if they averaged a 7% growth rate, that now grows to $284,000 that they could pay off that mortgage 10 years from now if they wanted to. But do they need to? The dividends would still cover the rental property expense. The cash flow is still in place, and they're generating cash flow now off of the 284. So it comes down to how many steps and how much time you have for each client or each individual scenario to say, how can we build this out? And at what point do we draw that income for the individual? So put yourself 10 years in the future. The 600,000 that you started with, if we utilize it, think of a company like AbbVie, for example, right? AbbVie, the last 10 years is, averaged somewhere between 8 to 12% growth per year, and it pays about a 4% dividend, right? So we never want to put all our eggs in one basket. I'm just using that as an example. But let's say that $600,000 is still continuing to grow. and you pulled your dividend off of it, you still have the 600,000 or the number of shares that you started with, and you still have the dividend. The rental property was 300,000, and hopefully it's worth more than 300,000, but you've paid down principal and interest and you only owe 250. So you have over $50,000 of equity in that example, plus any appreciation of the price, and you're cash flowing $18,000 a year off of it after expenses, which is built up almost $300,000 in a separate account that you could pay it off or go buy another property or go invest into something else, right? It's just the next to the next to the next. So if you're a younger investor, this 284, at a 4% dividend is going to kick off approximately, 6% or $6,000. And that's what you fund your Roth IRA with. So now you have 4 channels of wealth that are building, and it all started with that inheritance and just utilizing the dividend, which generated the next, which generated the next, which generated the next. So it's all about aligning your wealth so everything is working as a synergistic unit and building off of one another. So in review, you need to look at putting everything together. You want the double compounding because you want to accrue as many assets as you can and as many shares as you can. You need to make sure the assets that you hold are working efficiently for what your goal is, whether it's tax perspective, whether it's accruing shares perspective or cash flow perspective. And then you need to make sure that that money is in motion to generate more and future income for yourselves. Get the money in motion to build the channels, because once those channels are built, you will accrue wealth faster than you ever thought you could. So I know that this was a condensed version. We will go more specific and more in detail if you found this something that was highly beneficial, because we do have a few more examples to go through in the future. But it's 11:30 right now, and I said I would stop at 11:30. We'll take just a minute or two. If there's any questions that anyone has, I'm happy to answer them. Otherwise, after that, we'll get wrapped up and let everybody get on with their day. So any questions, feel free to chime in the Q&A tab, or feel free to message Jenna or myself. I'll give it just a minute here.
There are currently no inquiries in the Q&A.
Perfect. Perfect. So hopefully that means I did a really good job explaining things. And if you do have questions, please feel free to reach out to us at the Tranel Finance Group. That's what we're here to help with. Hope you all have a great rest of your day, and I'll talk to you soon.